Thank you, Mary Kate, and thank you so much for the invite. It's always a pleasure to be able to come and talk about an issue or issues that are close and dear to my heart. I'm going to give a landscape of the socially responsible area, and I'm going to try and be as broad as possible to incorporate everything that we're seeing in terms of socially responsible investing. So with that, we'll talk about trends first. I think as a starting point, it's important to level set. There's a lot of different words and descriptions that are thrown out regarding responsible investing. So we figure we start with level setting some of those and trying to put them in the context of the whole landscape. Responsible investing is really an umbrella term which encompasses many different types of approaches and many different methods and or tools. And so broadly speaking, if we look at the presentation here, and if we go from left to right, this is really kind of also kind of historical from what it has been in the past to kind of what is turned to its different iterations. It really started with what we're showing here on the left, socially responsible investment. This is values driven. So it was typically implemented via screens or activism. We move to the center, and here it's ESG, that's environmental social governance. And here, instead of being values driven, it's value driven without the S. Here we're trying to use any and all tools in the tool chest to add value. Again, not necessarily speaking to the values part of the equation, if you will. And then finally on the right, we have impact, which really is the merging of both the value and the values. And you really are seeking to capture growth from sustainability themes and really the merging of these two. Now you can also see one of the topics we'll address later today in the breakout is the stewardship or active ownership. And so I'll focus in on that a little bit later during the presentation. Now, there's different motivations that investors have for responsible investing. And these vary in degrees of relevance across the different groups. Some investors, particularly in more short-term in nature, really look at financial returns as all that matters. And for others, there's some variety of motivations that apply. I'll tell you that in the pension context, regulation really governs duty, which is often interpreted as maximizing return and aligning to what your peers are doing. Accounting for externalities, if you will, is deemed somewhat irrelevant. Again, this is very much in the pension regulation context. What do we currently see in financial statements? What is spelled out very clearly is typically issues of book value. What is more intangible, and we we show this as an iceberg. The imagery shouldn't be lost on you. What we can see is pretty obvious, but that typically is the tip of the iceberg. And so the intangible value, if you will, are issues around the E, the S, and the G. We're showing you some examples here in terms of the environment. This can relate to climate change, water availability, waste and pollution. It can manifest itself at the corporate level, if you will, via more obvious things like oil spills, unchecked emissions, or the actual lobbying against regulation. On the social front, you see three topics we list there. And here, if we kind of make it real, we see some events where there's a factory collapse, where there's clearly poor labor practices, and or there's contaminated or faulty products. And then finally, on the governance side, the board structure and diversity, the unfair compensation practices under the remuneration, and then, of course, the accountant and the audit quality and the errors around this. And we have plenty of examples in the past of companies that have been here. what we typically see is that for many of these, what we're calling here intangible value type of issues, there's ones that are not readily apparent, but that potentially cause a lot of harm once they come to light. And it takes a while for companies to recover from that. What are some of the drivers of sustainability themes? You see these here, consumer preferences, and I think if we look at some of the contexts now, for example, in defined contribution type plans and others, you're seeing that millennials are a demographic that not only want to maximize return, if you will, but they also want to do more than that with their money. And so that's an example of consumer preferences. Emerging technologies. I brought my iPhone up here, but I'm always amazed how I can combine a camera, a phone, a calendar, email. There's so many things that this phone can do that before I needed 10 or 15 different instruments to do. There's regulatory actions, and then of course there's resource scarcity. Very interesting article this weekend in our local paper talking about water scarcity, and how investors are trying to, I guess, take advantage of that long term and the potential impact and conflicts that it's having in different parts of the state. So that's also a very good example of that. Now, I think many times, and this is still the prevailing thought process now, whenever you talk about responsible investing or ESG, impact investing, et cetera, there's always the impression that you're going to give something up, right? If I apply any of these screens or criteria, or if I try to incorporate environmental, social governance into my investment process, I'm going to give something up. And what we're finding is that the data does not necessarily support that. But we're showing examples here across integration, stewardship, thematic, and screening considerations, where on the integration front, incorporating ESG, we cite two studies here. The one I'll just mention the one on the top, which is it's called a meta-analysis. There's a lot of technological firepower around that went around and looked at 2,000 or so studies where it actually showed that incorporating ESG didn't necessarily hurt you from a return perspective. We also look at stewardship and engagement, and a similar result from a perspective that you didn't give up anything in terms of return. From a thematic perspective, we're looking at things like climate change and realizing that whether it's a 1 degree or a 2 degree scenario or above what we would expect temperature, there are things and investment opportunities that can be had to actually try and mitigate that and also earn a return. And then finally, on the screening front, we show an example of what has happened if you screen out several sectors altogether, and depending on where those sectors are, the differences can be somewhat material to basically somewhat immaterial. So again, this is just trying to note the fact that in investing in responsible investing or ESG, you don't necessarily give up return, but you have to have some degree of flexibility, if you will. If we look at the segments from an institutional investor perspective, the segments where we see more responsible investment activity, it starts from where we see lots of activity, which is on the top of this chart with foundations, university endowments, public defined benefit plans, to where we're actually seeing less activity. And this is mostly in the corporate space, whether it's the defined contribution, the 403B space, which is more the defined contribution plans in non-for-profits, to the corporate defined contribution and defined benefit spaces. We've seen quite a bit of activity in the not-for-profit space. We expect that to continue. And if you think about it from that context, not too far-fetched from the perspective that an endowment foundation, you have a specific mission, and there's few people around the table that are figuring out what that, how that mission should be applied. If you go down to the defined benefit space where there's somewhat more regulation from a fiduciary standard perspective, and you're supposed to do what's best in behalf of all the participants. And there's thousands of participants, so it's very hard to determine how to apply some of these criteria, if you will. Which brings us to implementation. On the implementation front, and I think the operating word here is flexibility. There isn't such a thing as looking at your shelf and saying, all right, I need an ESG book, a responsible investing book that would cover me and would cover all the different beliefs that we have. And you can pull that and apply that. This is very, very specific, which makes it that much harder to get to and apply, and which is why you have to have a lot more flexibility when you're trying to determine, okay, we're going to apply a responsible investing program, or we want to apply environmental social governance in the context of investing. It's, and sometimes what I find with my clients is, all right, let's do this, Chris. I go, well, what exactly is it that you want me to do? Well, we should look out, see what, what's out there, and then we'll pick from one of those. And so you kind of do the reverse exercise. Instead of starting with the beliefs, and then how do we want to apply that? You start with what's available, and then we'll try and cram that into what we sort of want to do. So it's a very complex topic to get around, your arms around. We are seeing a lot of voluntary standards, if you will, and disclosure initiatives, and you see some of them listed here. Again, I think there's many entities that aren't necessarily directly affiliated, or have signed to any of these, but are still applying a degree of rigor to this because they want to maintain some flexibility. The growth of assets in responsible investing has been significant. Clearly, in other parts of the world, they're farther ahead in terms of applying responsible investing to their process. Particularly in Europe, you see that the growth in the US and some other countries has been significant. I will say, though, that if you're starting from a very low base, the percentages, even a small move of the needle looks significant. But clearly, I think it's very rare that North America is considered an emerging market. But as it applies to responsible investing and ESG, I think this chart and many others that we have would definitely show that. We're showing an example here of the total assets in relation to the whole, and you see over 60% of the assets in Australia, New Zealand, Canada over half, Europe almost half. Much of that in those countries is really driven by regulation. I hate to say it this way, but you have to invest considering environmental social governance issues. So that helps, I guess, from that perspective. Not so much in the U.S. and Japan, and here we're recounting, some of the challenges. The chief investment officer from Japan's government pension investment fund, which is one of the most massive and largest, I don't know if most massive is a word, but it's the largest fund out there. So it's just interesting to see that perspective. I referenced this a little bit earlier. Where to start? And we think the where to start, or what's next, really starts around the beliefs. And here, for example, what are our beliefs? If we're looking at climate change, what are our beliefs around that? How should we apply that from a policy perspective? What process do we have to have the checks and balances? And then how do we apply that to the portfolio? So this is just an example. And we're going to talk a little bit more about stewardship specifically and a program around that. And just wanted to, before we did that, just give you some context. Active stewardship is also typically referred to as active ownership, and it really involves voting your shares on a more informed basis, monitoring the company governance and performance, and in actually engaging with the companies towards some sort of shared goal. You notice that here, this doesn't necessarily mean exclusion or screening out. And there's a belief out there that we rather engage with the companies and make sure that they're listening to us and try to implement change that way than to do so by just screening them out. So it's an approach. And interestingly, it's an approach that obviously works on an actively managed portfolio. So you've hired an investment manager to actively try and beat some benchmark. But it also applies and tends to work very well kind of in more passive or index-like portfolios. That's when you hire a manager to just mimic a benchmark at a low cost without much tracking error or difference from the benchmark. Interestingly, there's quite a bit of stewardship that can be done there. And a good example of that is, there's many examples, but one that's been very public. The CEO of the largest asset manager out there, which is a firm called BlackRock, sending a letter to all of the S&P 500 companies and basically telling them, hey, it's not all about returns. There's other considerations that need to be made. We'd like to see what improvements you're making with this, with that. We'd like to see a more diverse board. We want to see what your initiatives for diversity and inclusion are, because we think all of these will actually be better for returns. And so you have an asset manager that is passive, that can't really alter the proportion in different stocks because they're hired to track an index, and yet they can have a significant influence as regards stewardship. We show you here just a quick process, and I think I'll just skip this in the interest of time, but it involves looking at your current practices and evaluating those. And again, I think we'll get more into this in a little bit. And then we show you an example of, and again, this is very specific to whichever policy or beliefs are developed, of how this can be tracked over time. We're just showing you an example of how some of our clients have done it here. And so I think with that, that completes the comments.